Hello everyone, I am Divya Grover, here to help you take informed mutual fund investment decisions. Passively managed mutual funds such as exchange traded funds, also known as ETFs, have gained considerable traction among investors over the past few years. Even though actively managed mutual funds still continue to be a dominant part of the mutual fund industry, the shift in interest towards passive funds is noteworthy. This is reflected in the growing corpus size of ETFs as well as expanding ETF offerings of fund houses in India. So what exactly are ETFs? ETFs are mutual fund schemes that aim to mirror the performance of a specific market index such as the Nifty 50 or Sensex. These funds invest in the same basket of securities as the underlying index and in similar proportions. What sets ETFs apart from other passively managed funds is that they are traded on exchanges throughout the day just like stocks. In simpler terms, ETFs are index funds that are traded on the stock exchange. ETFs aim to replicate the returns of the underlying index as closely as possible, subject to tracking error. The tracking error is the deviation of a fund's returns from its underlying index. Factors such as cash balance held by the fund, the time lag in rebalancing reshuffling of the portfolio in accordance with the index, and dividend payout are some of the factors that can result in tracking error. So here are the key features of ETFs. Number 1 is convenience. ETFs offer a convenient solution for investors who find it challenging to select the right actively managed funds for their portfolio from the plethora of options available. This makes it a convenient solution for those seeking returns in line with the market without the risk of active stock selection. Number 2 is flexibility in trade. Investors can buy and sell units of ETFs on exchanges during market hours. This is unlike index funds in which investors can transact only at the day's closing NAV. Since they are traded like stocks, investors can use standard stock trading orders including limit orders and stop loss orders, providing greater flexibility for managing their investments. Number 3 is demat transactions. A demat and trading account is mandatory for transacting in ETFs. The prices of ETFs fluctuate throughout the trading session as per the demand and supply, and the units can be purchased and sold at the prevailing real-time NAV. Number 4 is low expense ratio. Expense ratio for ETFs is significantly lower compared to actively managed funds as well as index funds. However, one should take into account the total cost of ownership, which may include brokerage and account maintenance charges. Number 5 is diversification. Initially limited to large cap indices, mainly Nifty 50 and Sensex, ETFs today span across mid cap, small cap, multi cap, thematic and sectoral strategies, smart beta strategies, fixed income as well as commodities. This broadening of options has allowed investors to construct a diversified portfolio of passive funds catering to different risk profiles and goals. Clearly, investing in ETFs has various benefits. That said, ETFs do have certain limitations. Number 1 is liquidity. Liquidity is an important factor to consider when shortlisting ETFs. Liquidity is usually higher for ETFs that track popular indices such as the Nifty 50 and BSE Sensex, but lower in case of other less popular indices. Therefore, buying and selling units at a preferred price may not be as convenient for ETFs with lower liquidity. Number 2 is no SIP option. The SIP option is not available in case of ETFs, which may prove to be a hurdle in following a disciplined approach to investing. However, some brokerages do offer SIP-like facilities for investing in ETFs. Number 3 is market risk. ETFs are not immune to market risk as their performance fluctuates in line with that of the underlying index. In conclusion, ETFs can help you earn decent returns in the long run, but ensure that you choose schemes carefully, taking into account their suitability to your investment objectives. And when you invest in ETFs, prefer the one with low tracking error so that the performance of the fund does not deviate much from the index. Further, for ease of buying and selling of ETFs, it is preferable to opt for ETFs with ample liquidity. As an investor, you would be better off avoiding sector and theme-oriented ETFs as they carry higher risk. On the contrary, if you are seeking better returns compared to the market over the long run, then actively managed mutual funds may be more suitable for your needs. As a developing economy, the Indian equity market may continue to offer alpha-generating opportunities across various segments. For more guidance on mutual fund investments, subscribe to our YouTube channel. If you like this video, please give a thumbs up and share it with your friends and relatives. Signing off for now. Happy investing. Mutual fund investments are subject to market risk. Read all the scheme-related documents carefully. Registration granted by SEBI, enlistment as IF with exchange, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. Investment in securities market are subject to market risk. Read all the related documents carefully before investing.